Hi, I've got Julie Crockett here from Australian Property Investment Solutions again. Julie, thanks for joining me.
Thanks, Mike.
Now, I want to talk to you about a topic that isn't getting a lot of press at the moment, and that's negative gearing. Obviously, I'm making a poor quantity surveyor's joke there. It's been all through the news. There's been a lot of talk about it since the last election, where Labor brought that policy to the marketplace and narrowly lost that election. They're looking a little bit better on this particular election upcoming. What do you think is the fundamental difference in the property market then as opposed to now? Do you think the policy is a good idea? Do you think the timing's passed? Let's just open the floodgates. Where are we on negative gearing?
Yeah, look, it's always an interesting one, and it's a pretty hot topic because a lot of people have purchased properties and they are negatively geared. Negative gearing is a tax treatment, basically, and a lot of people have been given the advice from their financial planner or accountant that they should be purchasing a negatively geared property in order to reduce their tax. And that will probably impact, if we have a change of government, there will be an impact if they can get that policy through to a negative impact on some investors. And moving forward, it will be a case, I guess, of people being strategic about what they purchase to get the best outcome, I guess, from a negatively geared situation with any change of government.
Do you think that will, if that comes in and as Labor say it'll start 1 January 2019, it'll be still available for brand new properties. Do you think investors will start looking more towards brand new property or perhaps chase commercial properties that are more likely to actually be positively geared anyway? What are your thoughts?
It's going to be really interesting to see whether people are still advised to buy negative gearing and their appetite for it.
Yeah.
I think one would assume at this point in time, being at this end, that investors will probably go after new to continue to get the tax benefits.
Yeah.
But it's very much a wait and see proposition. Whether or not that's the best outcome for investors, really, it's all about the strategy. So for some people, it could be a case of having, one negatively geared property and then several others that are positive cash flow. So having a mix and match sort of approach to investing to make sure that you're not too negatively geared, just to protect yourself and your interests moving forward.
As far as I understand, part of the motivation for the policy from the Labor government is that it's going to move investors more from established into new. The Labor Party said there's a 96% failure rate on the Insiders program and got smashed on that by the Property Investors Council of Australia, by a mortgage aggregator, and by us as well.
That's
actually,
right.
with our column, which I think is fair enough. It's not necessarily anti-Labor Party or anti-negative gearing, it's anti-dodgy data.
Correct.
So we actually know that around about 43% of investors are actually already purchasing new, which is a lot higher than I would normally think it would be. Like, it's quite a big proportion, and it's a lot more than the absolute maximum 22% that the Labor Party have modelled. I actually think pushing people towards newer property is a really risky thing because that's where most of the spruikers live, right? We all know about the stories of the developers, offering $50,000, $60,000. I mean, you're a buyer's agent. You could make a couple of phone calls today and get some real sweet deals with developers to put people in projects off the plan. I know you wouldn't, but that opportunity is there, right? You would know a lot more about that than I would. Do you have the same sort of concerns?
Yeah, definitely. Again, it may not be, the best type of investment for the investor. So it's really about strategy. I think. And then it begs the question too, what then happens to the existing properties? Do their values fall? How will that play out in future times is a little bit, I guess, unforeseen.
Yeah.
And so therefore, from an investor point of view, it's really about, what's going to work best. To answer your question, definitely it's a matter of looking at, I guess what's going to work best for the investor,
Yeah.
basically.
Yeah, and that's not to say that new property is the devil. You can certainly make great money even buying off the plan, heaven forbid. There are people that just say outright that's not a good idea, but I know people that have made serious money on it. But it's just kind of, it is a much better sort of, I guess, petri dish of these backhanded sort of deals, and I think if people aren't represented well by advocates, then they could potentially get into a problem.
Absolutely.
But I guess
and if I can say something there, Mike,
Yeah.
I think it's really important to work with people who are investors and not just people who are salespeople.
Yeah.
Because the difference is that people who are investors, and all of my affiliates and my colleagues who are working with API Solutions, we are all investors. So we know exactly what is going to work and what's not. A lot of people have bought off the plan and it's not working too well for them.
And I just hope that we don't see a lot of people burnt by that. But anyway, we will see what the results are. Just on the predicted results, I know we're probably bashing on about negative gearing longer than anyone wants to hear about, but can you talk to me about the two main predictions? One is that house prices will drop as a result of its implementation. We've obviously got the two-tiered market of you buy a brand new property and then you sell it and it's worth less because of the deductions. But property prices will drop and rents will go up. How do you feel about those two predictions? Do you think they'll ring true with negative gearing if it's implemented?
Potentially I think that could be the case. I think that with brand new properties, tenants like to rent brand new properties. They usually pay a premium for them, but like you say, after a couple of years, once those properties are not new anymore, and people tend to not hold their investments for a long term, so that's another interesting thing. Probably maximum of 5 years is where people sit with with holding investment properties.
Yeah, that's a whole nother
That's
episode.
a whole other story, but so it's very important that I guess we look at the potential risk in terms of buying brand new and then looking at the alternative, as you said, of buying existing property. Buying existing property, I think the ball game will change. People won't be buying, obviously, an existing property to negatively gear it because there won't be any deductions on it.
Yeah.
So one would think that they would then need to be looking at something that's positive cash flow.
Yeah.
And those properties that sit in the middle, those existing properties that are not positive cash flow and they can't have deductions made on them, they're in the grey area. And so I wouldn't like to predict that they'll fall greatly in value. We don't know really what's going to happen to those. But that's like I say, it's a grey area.
That's really interesting. Like Sydney, for example, the yields are really low, like 2%. If there are less investors active in the marketplace for established properties, then you would assume that the rental yields will have to increase because there'll still be people wanting to rent. There'll be less rental properties available. But we're talking like really sort of low yielding properties which might increase a little bit. But then there's the sweet spot ones that are maybe 5% yield, which is a lot of regional places and even some capital cities in Australia.
Yes.
Are they potentially going to have an increase in yields themselves, and there might be a swathe of positively geared property available?
Well, potentially. It's interesting. The properties that are situated in what we call the sweet spots, and you mentioned that term, it's a really good one. They tend to outperform the rest of the existing properties in a particular area. And the reason for that is because they're simply more desirable. They're in streets where people want to live and so on.
Yeah.
So they probably won't lose value because they're desirable, even though they are existing properties.
Yeah, it'd be interesting to look at those desirable areas which are desirable to owner-occupiers and investors compared to the markets that are investor only, and that's maybe where we see some of the price or the main price drops. But time will tell, I guess.
Yeah, that's right.
We'll stay tuned to see what happens.
Yep.